Uncertainty, inflation, inflexibility. Those are some of the concerns that come to mind when we think of the markets right now. Despite recent market optimism, we're very much concerned that money is flowing from strong hands to weak hands. What we mean with that is that banks that are insolvent or maybe insolvent, we don't really know, are being rewarded through government guarantees, whereas the strong players, thousands of healthy banks, are being punished because they can't compete without the government guarantee. We have Berkshire Hathaway, for example, and its annual letters to shareholders, Warren Buffett wrote that he can't compete on some deals because he doesn't have the government guarantee that other institutions that have cried for help have received. And similarly, on the consumer side, money is flowing to weaker hands. Consumers that can't afford their houses are receiving subsidy, whereas on the other end of the spectrum, we have people who have a decent income and they're threatened with higher taxes and may not be able to afford their houses anymore. The uncertainty in policies, where we have contradictions in many policies, let's just stay with the homeowner side, where on the one hand we have the subsidy, on the other hand we have higher taxes in terms of the phasing out of the mortgage rate deductibility. People just don't know what the policy may be. Other policies change every day. A bank can't really act because they have to be afraid of being dragged in front of Congress, whatever decision they may make. And while we certainly don't endorse some of the bank behavior, it is not an environment in which we're going to generate growth when we have too much uncertainty. When people are afraid, when things are uncertain, people stop to act. You do need a certain amount of trust in the market for capitalism to work. And then we have the Federal Reserve that, in our view, may want to have inflation. If you want to bail out those who have too much debt, you want to have a higher price level. You want to have the folks who are upside down in their mortgages to be bailed out through higher prices. And in our view, the Federal Reserve may do that by intentionally asking for inflation. One of the things the Federal Reserve is also doing is that they're distorting market prices. We have these massive programs to buy agency securities, treasury bonds. And what happens with that is that some people are happy about the low interest rates, but conversely, we are taking the free market dynamics away from those. Foreigners may not want to buy those anymore because now these securities are intentionally overpriced at the potential peril of the dollar. But conversely, we have an increasing number of American institutions that start hedging their US dollar risk. Think about it, hedging your domestic currency risk, something that has never happened with the US dollar before to the scale that we see happening in the market right now. And if people lose confidence in their US assets, that may drag on the US dollar quite extensively. The Federal Reserve is also building a substantial inflexibility into its actions. The Fed says it can mop up this liquidity at some point. Well, no, I don't think it can. First of all, by not encouraging a deleveraging, by not encouraging consumers to reduce their leverage, how can we reduce the liquidity? How can we raise interest rates when inflation comes into the system? We'd have a crash that in the economy that would be unprecedented. It's not like in the early 80s. There's far more debt in the economy. And second of all, the types of securities the Federal Reserve has been buying, an increase of $1.25 trillion in mortgage-backed securities, agency securities, that the Fed is committed not to sell again, and even if it wanted to, politically it may be extremely difficult. We just don't see it happening that they can easily mop up that liquidity. We think that the policies being pursued may accelerate the coming of another crisis. Crises have been coming at increasingly short intervals. So everybody out there, please be very careful. I'm Axel Merk. I'm the portfolio manager of the Merk Hard and Asian Currency Fund. Please subscribe to our newsletter at merkfund.com. Subscribe to this video, and we look forward to seeing you again soon.